Hey, how's it going? This video is going to be all about RRSPs, a overview of all of the benefits, all of the features that they have. If you are looking forward to that, hit that like button and stay tuned. So did you know that your RRSP is not actually an investment? Most people don't realize this. Most people confuse an RRSP with an investment, and the same goes for a tax-free savings account, an education savings plan, disability savings plan, or retirement income fund. They're actually just registrations, and they help the government classify your investments to determine how to tax you. So for example, if it's not registered, if you have investments that have just no registration, then you're going to get taxed to the full extent that the government can tax you. If it's in something like a tax-free savings account, it has different rules. Same with an RRSP. It's literally an umbrella that you can put all of these investments underneath. In other words, all of these registrations are tax shelters. So, in other words, what is an RRSP then? Well, it's a tax deferral system to be specific. So you defer paying your taxes from your high income earning years to your low income earning years because your income and the amount of it determines how much taxes are paid to the provincial and federal governments. So I have brought up an example where we are making $100,000 just for easy numbers, easy calculations. And in the first column, the without contribution, you can see that, again, no contribution has been made. I used just an example tax bracket of 40%. These will be much more specific when you talk to your accountant. But if you take 40% of 100,000, you're paying 40 grand to the governments collectively. But if you were to put $10,000 into your RRSP registration under whatever investment, even if you still paid 40% in taxes, you're down to paying them $36,500, a savings of $3,500. So that is the benefit this year of putting money towards your RRSP. So now let's look at retirement. So in retirement, you're going to be making a heck of a lot less than when you were actually working. As you can see in the top there, I've put $35,000 as the annual income because that's on average what a retiree makes. And I'll explain why in the next slide or two, but in retirement, your RRSP now has to turn into a registered retirement income fund, an RRIF, a RIF. And at this time, because you have such a significant drop in income, as you can see in the middle, your tax bracket's only 25%. So that's the point of putting money from today's income into an RSP because you're going to be taxed less in retirement since you're making less money and therefore paying the government less taxes, and you're giving yourself a retirement income to boot. So how do you know if an RRSP is going to benefit you? It's a generic program. How do you know you're going to be someone that gets some use out of it? Answer me this. Are you making more money now than a typical retiree does at $35,000? Yes? Then you should have an RSP. When you're in your high income earning years, you need to make a lot of income, one, because you have a life to live and you want to live it, but also because you're raising children, you've got a mortgage, you've got vehicle and possibly student loans that you need to pay off. Now in retirement, it's exact opposite. You don't need a huge income because you've got an empty nest. Your home should be paid off and your other debts and loans should also be paid off. So you shouldn't have a need to have a high income. And even if you want to go and travel, you still don't need $80,000 or $90,000 a year to go do that in retirement. Always remember that it is not a one-size-fits-all. To get specific answers about your specific situation, talk to an accountant. They're going to be able to tell you what your actual tax rate is and whether or not you specifically will benefit from an RRSP, because not everybody does. There are so many misconceptions, and hit that like button if you are one of the people that have these misconceptions about RSPs. The first one is that they don't actually make you any money. And a big reason people believe this is because they'll put money into an RRSP account, but they don't actually open any investment account underneath that umbrella. So what they're doing is putting money essentially into a savings account with the tax shelter of an RSP, and that's 0.05% to 0.5% as an industry average in savings. That's not even enough to cover inflation. So hit that like button if this was you before this video. Another big misconception that a lot of people have is that there are penalties to withdraw your RRSP money before retirement, and that's just simply not true. The penalties that people are referring to are actually withholding taxes that the financial institutions keep when you take the money out. And the reason they keep these is because your employer is only taking enough taxes for what they pay you every single month. And so when you add to that by withdrawing from your RSP, because it does add to your taxable income, the employer hasn't taken enough off, so you're going to be left with this tax bill at the end of the year. However, with the financial institutions keeping money back and sending it to your tax account with the CRA, you're going to have a buffer there. And so you're going to get the difference if they took too much at the end of the calendar year, or you're going to have a heck of a lot less to pay if they didn't take enough. So if your income is $100,000 with your employer and you took out an extra $3,000, your taxable income is now $103,000, and you will have some more taxes to pay on top of what has already been taken off of your check. And that's what it's for. Remember that it's a tax deferral system, which means you can pay your income tax later, ideally when your income is lower. Not never. It is not a tax-free program. It is a tax deferral program. Now, we know there are no explicit penalties for an RRSP, but there is an implicit one. If you deposit into your RRSP and then later withdraw that money, you lose that contribution room for good, forever. You do not get that back like you would with the TFSA the next calendar year. It's just gone. So there are two programs associated with the RRSP. The first program is the Home Buyers Plan, and this allows you to borrow from the RRSP account in order to purchase your first home. In order for it to qualify as your first home, it doesn't necessarily need to be the first one you've ever bought, but it needs to be the first home under your name in the last 4 years. As of 2019, you can actually borrow $35,000 against the account by withdrawing from it. Now, this again can be for you, but it can also be for a relative with a disability. In order to pay this back, because as you can see, it says borrow on the screen, all you need to do is recontribute to the RSP, and you have 15 years to pay it back. So if you took out $15,000, you would have to probably pay back, what, 15 divided by 15, $1,000, starting from the second year that you've borrowed. The lifelong learning plan is the same thing, except instead of buying your first home, it's to go back to school, and this can be used by you or your spouse. The repayment period for the lifelong learning plan is not 15 years, it is 10 years, and the maximum per person is $20,000, so that's $10,000 per year. This is not an account for your kids because your kids have the registered education savings plan, and that is completely different. It has its own terms and benefits like grants and whatnot. So this is just for you. So getting your limit is actually pretty simple. You just have to go online to the CRA website. It's called CRA My Account. And if you haven't registered, you totally need to do so now, just because it is so easy. You can get all of your T4s, tax slips, you can do a ton of stuff, but it has your contribution limit always up to date. So it's all of your previous year's unused contribution room plus 18% of last year's earned income. So in our example, we used $100,000, and again, multiply that by 18%, and the limit increase for 2021 is $18,000. Now, the maximum that you could have used for your 2020 is $27,230, just because it's not meant to be unlimited. So if you made more than $151,277, then anything more than that, it's not going to apply to your limit. The deadline is March 1st, 2021 to put in your RSP calculations, and that's going to be different every year, but it's typically the first 60 days. So it'll be either February 29th to March 2nd or 3rd is typically the average. And we are done. So that is a brief overview of the RRSPs. You can absolutely go into more depth with all of this and find accurate information. A lot of my numbers were just examples. If you want to hear more about TFSAs, hit that subscribe and let me know down in the comments if you'd like to hear that. Hit that like button if you found it useful. Share the video if you also did. And I hope you have a fantastic day and a great tax season. Bye, guys.